Risk on or risk off? The Fed decides tomorrow, but the market making a decision today. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, and we made it to the end of the month. Happy end of April.
Happy end of April. Let's hopefully May is a little bit better.
Means leave your long stocks. You did not enjoy April. So here's where we're at. We're around the lows of the session for the S&P, off by a full 1 percentage points. Most of the major sectors are in the red. Alongside that, you have a sell-off in the bond market. Everywhere you look, on offer. You have yields up on the 10-year by about 6 basis points, a trend that we've seen over the last 4 weeks. I just wanted to highlight cocoa. It is up 3%, but honestly, that means nothing because it was down 27% over the last 2 days. It's been a very volatile commodity, and other commodities like oil, copper, also very volatile today as well. And this is my daily check-in for Romaine on dollar yen 157. It does seem like there was intervention at 160, the new line in the sand, but the problem is the dollar is breaking stuff, which does set us up for the Fed meeting announcement tomorrow. If it breaks stuff, dollar goes higher. What else fails? Romaine.
Absolutely. Here, a lot of catalysts battling this market around here, and a couple of key economic points that we got to focus in on, because that really is setting the tone for the trading that you're seeing today. A down day. An index of U.S. wages and benefits, the employment cost index, jumping 1.2% in the first quarter. That exceeded all projections in a Bloomberg survey of economists. You had a Case-Shiller index of home price increases nationwide. That accelerated for a 9th straight month. And a measure of U.S. consumer confidence that fell to the lowest since mid-2022. Views of the labor market and the economy really deteriorating, and it all adds to mounting evidence that inflation and inflation expectations remain a threat to economic stability. Now, that is the backdrop for the Fed at their latest policy meeting, a 2-day meeting that began today after months of dovish commentary by the Fed, including Jay Powell himself. But we've come a long way from that surprise dovish pivot back in December. Whatever expectations the Fed had for cutting rates this year is clearly being challenged by that economic data, a reality that Powell himself was forced to acknowledge earlier this month on the margins of the IMF spring meetings. He said it is appropriate to allow restrictive policy further time to work, end quote, which is just basically lawyers speak for don't expect any rate cuts anytime soon. And so the great market unwind began. First with options traders, repricing Fed rate cut expectations from 6 cuts this year now to just barely 1. And then you had that equity rally. Investors really taking a lot of chips off the table. In April, the S&P erasing all of its gains from March, a similar story, and then some for the NASDAQ and Russell. A survey conducted by 22V Research showing that only 16% of investors polled expect a risk-on reaction to tomorrow's Fed decision, but 44%, Alex, saying they are expecting a risk-off, the remainder saying neutral.
Right, so is that like an asymmetric risk? Is that symmetrical risk? I'm really not sure, but I am sure in that if you own a 60-40 portfolio in April, you didn't love it. And this shows the monthly return for the S&P, which is the white bars, and then for the Bloomberg U.S. Treasury Index total return, which is the blue line. And you can see this is the first monthly decline that we've had for the S&P in the last 5 months. We haven't seen this since the end of last year. Similar story for bonds, right? You're seeing yields on the 10-year at the highest for the cycle, second highest for the cycle. The last time we saw this was back in October when you had this kind of monthly decline for the Bloomberg Treasury Index. And I guess it raises the question, Romaine, have we shaken out enough? Is this the start of a deeper correction, a push to 5% on the 10-year, a deeper correction in the equity market, or are we going to see the buyers eventually come in? Is it still buy the dip?
All right, hold that thought. We're going to get back to that in a second, but some breaking news on the founder of Binance, CZ, Changpeng Zhao, we have learned has been sentenced to 4 months in prison. A U.S. district judge in Seattle addressed CZ earlier today in court, giving him 4 months in prison. Prosecutors had been seeking at least 18 months in prison here based on the sentencing guidelines. This, of course, stems from the charges against CZ and his failures that prosecutors say allowed cyber criminals and terrorist groups to freely trade on what was then the world's largest cryptocurrency exchange. CZ, 4 months in prison. We'll get you some more details on his sentencing and the ripple effects from that in just a second. But we do want to go back to the big focus of the day, and that is on the economic data, that is on the Fed and a big decision tomorrow. Vanessa McMichael joining us right now, the head of corporate and public entity strategy over at Wells Fargo, to kick us off to the close. And Vanessa, I do want to start with those Fed rate expectations, which have just really done a complete 180 from where they were just 3.5, 4 months ago. Not surprising given the economic data, but do you think the expectations have maybe ratcheted down too much?
Well, thank you for having me first off today. Very interesting topical question, Romaine. So this is the topic of choice with our clients today, and it's been kind of confusing for our clients. Our clients have not thought that the Fed would not cut at all this year. That hasn't been the discussion. We had conversations earlier this year with clients who felt that the 6 rate cuts were overblown too much. And so now we're in this place where the market is expecting only 1 cut. And so our clients are still thinking that we're going to cut at some point this year. At Wells Fargo here, our economists are expecting 2 cuts, the first in September, the final one in December. But obviously with the recent economic data that continues to come in, there's some risk that perhaps 2 could turn into possibly only 1.
And you mentioned your clients, Vanessa, and we should point out for our viewers, your clients are primarily corporate clients as well as some municipalities, public entities there. What exactly are they asking, though? If they are of that belief, or at least they have of that concern about interest rates and the Fed here, are they asking for meaningful changes in their allocations?
So we're seeing a divide. We see clients who are using the Fed's pause, a potential prolonged pause, as an opportunity to remain in cash rates. So money market funds, right? It's money market funds have been a topic that we have discussed when I've been on your show before, but that becomes a default because of the rate environment. And then you have another set of clients who see this as an opportunity, meaning the environment that we're in today, right? The 2-year back above 5%. It's kind of a you don't know what you got till it's gone sort of a theme, because we did see rates fall pretty dramatically in January to start the year, and now they have risen again because of Fed expectations. And so some clients are considering this an opportunity, and so we have seen year to date, while the allocation to money market funds from a dollar perspective looks to be pretty stable, from a total portfolio allocation perspective, money market funds has dropped year to date. So in February, we saw a smaller allocation in corporate portfolios to money market funds, and also in March, and we saw that replaced with other money market instruments like T-bills or maybe even commercial paper.
Wow.
So it's all still in the same idea, right? And is it for the absolute yield, or is it for actual appreciation?
Well, what we're talking about with these corporate clients is their excess cash, right? And so since COVID, corporate clients generally, if you look at public data for cash and cash equivalents, we're seeing cash balances. They're just way more robust than they have been historically. And so when we see these opportunities, is to take advantage of the yield, Alex, to answer your question, to generate some more income for a slightly longer period of time.
Is it a duration? Where do you feel like your clients are most interested? Is it still that short term? You're mentioning bills, you're mentioning the 2-year, rather than taking that duration risk at this time?
So with our corporate clients, it's really all over the board, Alex. A lot of times, though, corporate clients can only invest out 2 or 3 years in their investment policy. So right now is the time where, for those clients who are comfortable moving some of that excess cash out of money market funds, they may be looking at a 1-year T-bill or even a 2 or 3 year Treasury note at this point.
All right, great stuff. I remember even a couple of months ago, it was like, maybe we need to move that money out of money market funds. Now, not so much. All right, Vanessa McMichael, thanks very much. Head of Corporate and Public Entity Strategy over at Wells Fargo. Back to that breaking news from earlier. Binance founder CZ sentenced to 4 months in prison on anti-money laundering charges. Joining us for more is Bloomberg News reporter David Gura. Okay, David, walk us through the perspective here. 4 months.
Yes, much less than the prosecution wanted. Those sentencing guidelines were 12 to 18 months. The prosecution wanted 36 months in total. So 4 months is radically less than what they had hoped for. And the judge, when he was handing down this sentence, was largely unsympathetic to the argument that the government made that this was a calculated decision by Changpeng Zhao, by CZ, to evade money laundering rules, to not have a money laundering program in place at Binance. So a slap on the wrist, I think you could characterize it as in terms of like what it might have been otherwise.
And we should point out, I mean, he pled guilty to these charges, anti-money laundering charges, and there was another charge in there I'm forgetting here, and he agreed to pay a pretty hefty fine.
Yeah,
right?
$50 million. Yeah. And I think what's tricky about this is it's entangled with this other plea deal that the company made for $4.3 billion. Mm-hmm. So in that is a swirl of all of the things that Binance admitted to doing, that is facilitating a lot of transfer of money among illegal entities. He very narrowly pleaded to this charge of just not having this money laundering program, anti-money laundering program in place. So all of that exists on the sidelines, but his was much narrower than that.
All right, David Gura there, a closer look here at the sentencing of CZ Changpeng Zhao, the founder of Binance, getting 4 months in prison, well below what the sentencing guidelines had recommended and well below what prosecutors had sought. That's just one big story that we're following right now. We do want to go out to New York and into Columbia University, where colleges are rushing to confront the pro-Palestinian demonstrations on their campuses with disciplinary actions escalating and campus life thrown into turmoil as the academic year coming to a close. At Columbia here in New York City, students have occupied a campus building and barricaded themselves inside. Our very own Scarlet Fu is on the ground outside of that building right now, Columbia University in uptown here in New York City. Scarlet, what do we know right now? Are the protesters still inside that building?
Yes, we understand about 60 protesters are barricaded inside Hamilton Hall, which is the building right behind me. They've unfurled banners that say things like Free Palestine and Intifada, and they have said that they will not leave the building until the university gives in to their demands, which includes disclosing their financial investments and divesting from companies that do business in Israel. The university overall is in lockdown mode, meaning the gates are shut to only students who live on campus. They're the ones who can get past security, past the security tent over there. Nonetheless, you are seeing protesters outside by the gate. There's some students in there along with some bystanders. We see NYPD, some scattered NYPD officials around the campus or outside of campus, but they've told me they have not been called in to the campus, unlike in other parts of the country. Now, Columbia has finally responded to that student occupation as well, saying that protesters have chosen to escalate to an untenable situation, and students occupying the building face expulsion. Those who do not leave the encampments that were set up about 2 weeks ago are now being suspended. Seniors can't graduate as well. But Romaine and Alex, this is a clear escalation from the encampments that were initially set up to coincide with the president of Columbia, Manoush Shafiq, testifying before Congress.
So that's the response from Columbia. What are the students still demanding at this point?
Right. They're demanding disclosure, so they want to understand what the university invests in, the $14 billion endowment, and they are demanding divestment from Israeli companies and companies that do business in and around Israel. This is obviously an easy thing to press for, but a difficult thing to actually do, because endowments, they don't just invest in individual companies. They invest in mutual funds and index funds. They invest in hedge funds and private equity and venture capital and hard assets like real estate. If you are looking at a company like Microsoft that does business in Israel, or Lockheed Martin that sells weapons or defense systems to Israel, how do you divest out of that company but still maintain exposure to, for instance, the S&P 500 or to the rest of the sector? It's a difficult thing to disentangle.
Yeah, you can say that again. All right, Scarlett, great reporting. It's great to see you up there. Scarlet Fu, thank you so much. Much more coming up ahead on the close as we end up April. Market trading heavy. This is the close on Bloomberg. The cost of U.S. homes picking up in February. We got the data today. Prices climbing 6.4% from a year earlier. That's larger than the 6% annual gain back in January. Joining us for more insight is Francis Katzen, founder of the Katzen team over at Douglas Ailman Realty. Now, the firm is out with the new reports on real estate here in Manhattan. And my dirty secret is every morning I wake up and I look at Zillow and I look at StreetEasy and I look at all the stuff that's coming up. If you were to describe what Manhattan real estate is doing right now, what's a word you would use?
A contradiction.
Okay.
In every way.
Explain.
We have, for rental luxury, we are up on a price per square foot basis for the fourth time in 5 months, yet our median price is down 4.5% with a slowdown on lease signing. Our sales market is basically a wholesale market. We have amazing capitulation and opportunity, and the buyers who are needing that financing are basically locked out because they don't want to give up what they have, which is on average 2.5% to 3.5%. So there's this constant flux, and we're not following the 10-year Treasury yield like we did in December when it dipped below 4% and the 30-year went down to basically 6.5 or 6.25 from 8. Now we're stuck. We're sort of at a disconnect. So it's a very strange time for real estate.
Why does that happen with the 30-year and the 10-year?
I suspect we track it because it's one of the U.S. Treasuries that we value. Mm-hmm. But also, I think we're also a little bit frightened, maybe the lenders are, to trust Powell's prediction on the Fed. To be honest, tomorrow's going to be a big day.
Do you think, though, that that will clear it up? I mean, there is some expectation that he might at least telegraph maybe a slower path for those rate cuts that everyone had priced in. Is that going to matter for the real estate market, or do they want something a little bit more definitive?
I think it's going to slow down a lot. I think if it doesn't happen, I think we're going to have this constant sort of growth of divide. But I think if there's a little bit of movement, I think it's going to spur a massive jump for people who want to get out of paying sugar high rents and actually get back into equity and take advantage of a softer capitulated sales market.
I am curious, in the luxury space, for those folks who are renting and maybe are looking to buy here, what is the impediment if they have the financial resources to do so, even if it's at a 7% rate or whatever the average is right now? Is there not sort of a sales pitch to those folks that, okay, you can lock it in a 7, maybe the Fed will cut rates and you can refinance in 2-5 years or whenever? Is that not a sales pitch?
That is the sales pitch.
Okay.
You can always refinance.
Wow.
Yeah.
Do you have any job openings?
But,
You can always refinance.
but is that really always refinance? Take it now, take the hit now, and you can refinance later. People buy that?
Yeah, because people are priced out typically in the New York market. It's the most expensive market in the US. So there's an opportunity to get in much more aggressively now than you might have when the rates go down, the pricing goes up, and the demand goes in, and you have less negotiability.
And I would say this is not all that unique. We went through something when I bought my first house. This was kind of right before the housing crisis. I mean, you were paying, 5 to 6% to get in the door here.
Yep.
But that was the sales pitch. The sales pitch was these rates aren't going to stay at 5-6% forever. They will go down, and they did. And over the the course of 10, 12 years, I think I refinanced 3 times down to 3%.
Which is insane, right?
Yeah.
So I think that people buyers in particular are having to make peace with the fact that they may never get the 3.5% and 2.75% rates. And therefore, people are trying to get their head back to 4.5 to 5.6 to 6. Right now, we're at, on a 30-year, we're almost at 7.2 to, we're oscillating between 6 and 7.8%.
Right, so take the hit now.
That's
because
right.
the housing price will be quote unquote lower.
Yes.
Rather than wait until rates go down and the housing price goes up.
Correct.
How many people are buying with cash?
63.4%.
So that is insane.
I know.
So the ultra rich can no problem paying for cash with this. And then we're talking about a different kind of bottom for those that can't afford it.
Well, that's the whole struggle. We were hoping that people could get in and take opportunity, and that's been the big struggle. 26% of these finance deals are getting parents to help them because the rate is so high they can't make the numbers work.
We keep hearing about how it's the new home, the existing home sales are the problem, right? No one's putting their stuff on the market, but there's tons of supply when it comes to actual new home sales. Is that actually true in Manhattan?
Not really. We're down 20.1% on inventory, which is what is holding some level of pricing if the seller prices appropriately. If they're overpriced, there's not a lot of takers.
Is there any historical parallel to this? Because I don't see how you get that inventory level back up if, as you say, everyone's afraid to leave whatever 2-3% mortgage rate they have, and to swap that out for 7%. Why would you do that? In theory, at some point, people are going to be forced to move, whether it's deaths of certain people or job relocations, family situations, changes. But is that going to be enough to change the inventory situation?
I think eventually everybody has a shelter need. And I think ultimately that's going to be the driver. The big issue is where does it land in terms of how you hold value? Some sellers are having to come to terms with losing in order to take the bigger opportunity because the upside is so much better.
What about for those folks who have the optionality for multiple homes? And we seem to be talking about people that are going to have one home, one primary residence, and that's just it. As you know, there's a whole cohort of people out there that they want multiple properties. Are they still active in the market?
Very.
Yeah.
Very active.
Are they dominating the market?
Yes,
Yeah.
they are.
Yeah.
It's a pied-à-terre consumer. The 3 biggest places to make value right now is Miami, LA, and New York.
Yeah. Okay. All right. Well, it's great to talk to you, Frances. I think we have to leave it there. Frances Katzen, founder of the Katzen team over at Douglas Ailman Realty here. A closer look at the real estate market as we continue our coverage here on The Close, counting you down to those bells 40 minutes away, and a closer look at what's going to be one of the big market events after those bells, and that is Amazon. Its latest quarterly report set to drop, and investors will be focused on everything from cloud to AI. Laura Martin joining us right now, senior entertainment and internet analyst over at Needham. She has a buy rating on those shares. Laura, great to see you again. We haven't talked. I think the last time we talked was probably last earnings season. Look, I mean, this seems like one of those pivotal earnings seasons. I think the last time I asked you about this, I think everybody was still kind of like, is Jassy, has he gotten it right? Has he found sort of his groove here? The stock has done pretty well. Investors and analysts alike seem to be giving him the benefit of the doubt. What are you expecting tonight?
So expecting 12% revenue growth, 83 cents a share in earnings, 12% AWS growth, which is a slight deceleration from the 13% revenue growth last quarter, but 23% ad growth. And I think advertising, AWS, the cloud has about 30% margins. They report those. I would guess that advertising has 60% margins. So I love the fact that the fastest growing business in their portfolio is growing twice as fast as everything else with twice as high a margin. So that's my favorite part of the Amazon story.
Well, then let's talk a little bit about the streaming side of this business, and obviously ads tied directly into that. This is a company that's been pretty aggressive about its expansion into that. There's been a lot of discussion about its further push into live events, particularly with some major sporting league contracts coming up for renewal here. Do you think that we're going to get some details out of the company on that today?
I do, and I think they're going to get a question on, now that they've bought NBA rights, what does that bode for their NFL rights when those come up, because those are really expensive? And what kind of feedback loops are they getting from live sports that they're bidding higher and higher? Are they getting better churn? Are they getting higher price points? I think all those are really interesting questions having to do with live sports on Amazon Prime Video.
Let's go to the cloud part, AWS. What are you expecting in terms of growth there? I mean, it feels like in a year and a half, it went from 20% growth to 12% growth. Have we hit kind of the bottom? And what do you think for today?
What I would say is, I think the big issue that's going to move the stock is guidance. But I also think generative AI, as we saw with Meta, generative AI was all bad for that stock, down 15%. And then Google came and talked about generative AI. So I actually think it's sort of more generative AI that has the most upside in the stock here, along with what they say about the investment cycle.
So I was talking to another analyst earlier today, and it was like, look, the AI for Amazon, though, just lacks the same kind of punch that the offerings that Google and Microsoft have unveiled and are sort of pushing forward. It sounds like you may not agree with that point.
I strongly disagree with that point, because I think Meta is now saying they want to make the biggest, best large language model, which feels like it's directly competing, even though it's half the size, with Google and Microsoft. And that is not Amazon's strategy. Amazon's strategy is like, look, large language models, come house yourself on our cloud. We don't have a conflict of interest. We don't have a favorite. We don't have our own large language model that we care that much about. I actually think that's a brilliant strategy, because once you get these large language models built on AWS, the Amazon cloud, they cannot move. There's no churn. Amazon is locked in an annuity stream for them. So I actually think Amazon's strategy is the smartest in point of fact.
All right, Laura, we gotta end this with, I got two questions, a two-parter. The first is Whole Foods. What the heck is going on with that? I mean, everyone scratched their head when they bought this thing, and they were supposed to do something magical with it, and I'm not seeing the magic. Why do they still own this thing?
Yeah, it's such a great question. They refuse to fail. I mean, they keep iterating, they keep trying to get it. It's not working. Now they're going to subscription grocery. I don't think that's going to work either. It's a mess. Grocery's a mess. They still haven't figured it out.
Do you think do you think, though, there's a case to be made for having that brick and mortar retail strategy? So whether it's Whole Foods or these other sort of, I know they've kind of discontinued the Amazon Go stuff, but they've clearly experimented with that on a lot of levels, the bookstores that they had. Do you think there's still a need or desire for that?
Good question. I mean, I think they're going to keep iterating, but the great thing about the Amazon culture, if they can't turn it into a legit business, they're just going to walk away. They're just going to shut it down, because they really are business people at the end of the day. But boy, have they been struggling with this segment of commerce.
All right, Laura, thanks a lot. Really appreciate it. Thank you very much. We are looking forward to the next half hour. Laura Martin over at Needham, thank you very much. I was talking with Gene Munster, is who we were talking about when it talks about AWS and cloud. He also made the point, whether you agree with it or not, is that there's a real chance for retail to take on more importance for earnings and more important for revenue in the future because of robots and logistics. Roll your eyes if you want, but it's a possibility.
Yeah, I think so, though they got to fix the consumer-facing side of that. I mean, we know Amazon has been a killer on what's on the back end. I mean, let's face it. I mean, they're not really a retailer. They're a logistics company, and that's what they've done well. But I think the consumer-facing side of this has suffered, at least based on my own personal experiences on Amazon.com. And then, like I said, I really have no idea what they were trying to do with Whole Foods.
Oh, the whole big thing.
I'm completely
yeah, I mean,
lost.
Yeah.
Like,
also, grocery is not a margin business.
Yeah,
like, it's just,
I
it's
don't
just
know.
not.
I don't know.
All right, coming up, we're going to get back to that breaking news from the top of the hour. A billionaire behind bars. We're going to get more perspective on Binance founder CZ's sentencing. This is the close on Bloomberg. You're looking at S&P around the lows of the session, down by 1.1%.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So today's the day. It is not only Amazon Day. It's not only the end of April, but it's 11% of the market cap of the S&P reports today. And a bunch of that comes after the closing bell.
And a big question will be, is actually going to save this market? I mean, we've had some pretty decent earnings, but you've seen the price action all month long, really, in April, and certainly over the last couple of days. It's just not enough for investors right now, particularly coming off all those monster gains in the first quarter.
Well, I keep hearing more about the CTAs that like they're going to have to buy no matter what. Where the market goes depends on how much they buy. I don't know. Whenever I hear about CTAs, I kind of glaze over a little bit.
Yeah, I mean, it's always good, but I always feel like they're much more of a corner of the market. I know we like to pretend like they drive the market, and they think they drive the market, but I feel like they're much more of a corner, a pocket, if you will, Alex.
Tell them that.
I know, don't tell them. We love them. They're great.
All right, let's get back to crypto and the breaking news.
They're no McKinsey consultants, but they are pretty good, yeah.
Maybe they listen to rap music at partner meetings. I don't know. Binance founder CZ has been sentenced now to 4 months in prison on anti-money laundering charges. Want to get more perspective on this and what it means for the broader crypto space from William Quigley, co-founder of Tether and Wax, aka Worldwide Asset Exchange. Hey, William, good to see you. Your reaction to 4 months?
I think it's very good for CZ. 4 months, given the charges, I think was much better than expected. Better, I think, than even his defense counsel was hoping for. The U.S. government was saying at least 3 years for a prison sentence. But the judge seemed persuaded by the fact that he has not had former issues with the law. His company also paid over $4 billion in fines. It appears he was cooperating. There was a settlement agreement in place where, up to 18 months he would have accepted without challenging. So I think this is tremendous for him.
And it does seem like there's going to be monitoring of the business after this also. Do you feel like whatever monitoring will be in place will be enough and send the right signal to the industry?
Yeah, though I would say it will be a bit of a challenge for Binance because they've always been a very distributed workforce. I don't know to what extent they have all of the processes in place. What does monitoring mean? For how long will it go on? We just don't know, but it probably will curb their business to some extent. But in addition, I don't think either the FTX issue or Binance is nearly as threatening to the crypto industry in the US as Coinbase, as Uniswap, as XRP, where the SEC is driving to stop those businesses from operating. So I think that's something which is still to come, what will happen there. Those, I think, are much more impactful to the crypto industry than Binance and FTX were.
Yeah, it's kind of curious. I mean, Binance is certainly held in there, and I even saw the most recent data out them. The big increase in holdings are now back up to that $100 billion level. So there's still the big beast out there, the big player, if you will. I am curious as to, A, what you think is driving that and why you don't think that there was more of a backlash given the charges against Binance and CZ?
I think things like anti-money laundering and failure to comply with the CFTC regulations and whatnot, these are very arcane things. They're, in the bowels of the banking industry. So I don't think they resonate the same way, for instance, finding out that the exchange was stealing all your money, as was the case of FTX. So it seemed more like an administrative issue than it did sort of a crime against the customers. And I think that's why there's been less of a of an impassioned group wondering what's going on.
Well, that seems to be what the judge implied during the proceedings here, that this might have been more of a lack of oversight rather than any sort of malicious, intended crime. But I mean, just to play devil's advocate here, though, I mean, does that necessarily let them off the hook? I mean, at the end of the day, as we know, financial transactions, whether it's in crypto or the more traditional world, to a certain degree is about trust in the counterparty,
Absolutely.
Trust in the platforms that you're trading on here. And it doesn't seem, at least in the long run, that trust has really been all that shaken.
No, it has not. And again, I just think it's because people don't think of it as an issue against the customers. This is more like failure to comply with certain arcane regulations. So I just don't think it drives the same level of passion that when you hear about an exchange stealing from you does.
Yeah.
I will say, though, this could be difficult. The compliance with whatever oversight is going to be put in place, that is, to me, unclear. To what degree that the exchange's operations will be hurt by being much more restricted in what they can do. That is just, we're waiting to see. Binance is, I think, one of the largest. It's certainly by far the largest crypto exchange globally, but it's probably also up there in the top 1 or 2 when it comes to crypto derivatives.
Yeah.
And they're very important.
Well, that's what I'm curious about, what the structure ends up looking like. I mean, but before they got these troubles there, and obviously with the fallout from SBF, they kind of took pride in this idea that they were basically borderless, right? The idea that they didn't really have a headquarters. They weren't really tethered to any one country. I've gotten in trouble for, mixing up Binance US and the overall umbrella Binance. And they always sort of made hay of this idea that we're kind of everywhere and nowhere. Of course, we know regulators don't like that. They want you to be somewhere so they can keep an eye on you. Does that, if they do end up at that kind of structure where they have to be tethered, at least from a regulatory and legal perspective, to one particular jurisdiction, and assuming that jurisdiction is probably going to have to be in the US to some degree, does that hurt its appeal?
Yeah, and it's a question I don't think we know the answer to yet, but Binance, the vast majority of Binance's revenue, its trading volume, comes from outside the U.S. In fact, only Binance USA, which is now shut down, was allowed to onboard U.S. customers. So presumably, Binance Global is not working with U.S. customers. And whether or not it will therefore still comply with all of the U.S. rules that, let's say, a Coinbase does, I don't know. I don't know how easy that would be to implement. But clearly they're going to do anti-money laundering and know your customer regulations, because that seems to be more of a global standard. But as far as, are they going to comply with the CFTC and the SEC, U.S. Treasury rules, I think that would be hard to do. If you look at the size of Coinbase, which started, by the way, years before Binance did, Coinbase is much smaller because it has to operate within these rules in the United States that are more restrictive. So I don't know what the long-term plan is, and maybe Binance doesn't even know what the long-term plan is.
Yeah, well said. All right, William, got to leave it there. William Quigley, co-founder of Tether and Wax, a closer look at the sentencing of Changpeng Zhao, of course, going into prison, federal lockup for 4 months, well below what prosecutors had recommended. And we should point out a fun fact here, if you will, he will actually be the richest person in U.S. history to actually enter a federal prison. All right, coming up here, we're going to focus on some of the big movers on the day, including 3M. Dividend aristocrat, an aristocrat no more, slashing its dividend after 6 decades of hike, and the shares are rallying. It's our stock of the hour. It's coming up next, right here on The Close on Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been? Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Time for our stock of the hour. 3M shares up about 6% here on the day. This after the firm announced plans to slash its dividend, ending more than 6 decades of boosting the payout. Bloomberg's Kyle Porter joins us now with more. We should point out, Kyle, I was just doing the math here. You have basically something like 67, 68 dividend aristocrats out there. These are the companies that have basically been raising their dividend, I should say, for at least 25 consecutive years or more. This was also the third highest dividend yield in the S&P. They're slashing that. Why?
Well, in a nutshell, it was time. The company announced last year and completed this week the spin-off of its healthcare unit, Solventum. Following the removal of that company, they simply couldn't support a dividend of this size.
And the other part is, they're one of the big conglomerates really still left as an industrial, right? Everyone else is going to trim the fat, spun off stuff, and they're sticking to it. They're getting a new CEO. How does this help clean the slate and set up the new CEO?
Well, it gives them more room to play with. 3M has always prided itself as an innovation factory. It has an R&D budget far higher than any of its peers, either conglomerated or deconglomerated. By having a little bit more money to play with, you would hope that 3M would start producing more of the game-changing products that it's been known for, rather than the singles and doubles it's been pushing out recently.
Let's talk a little bit, Kyle, here, though, about the share reaction. Of course, this came on a day where they did report earnings that you can see there, our viewers can see there on the screen here, that appeared to beat on both the top and bottom line. When you take into account their earnings growth over the last, really only last couple of quarters, the new CEO coming in here, and now what looks to be somewhat of a dismantling of the conglomerate style of this business here, is that why we're seeing such a positive reaction?
Well, they certainly surprised on the earnings per share on the upside. The market was very pleasantly surprised by that. And there's also a bit of a received wisdom that when a dividend aristocrat retreats from that, they generally see their market capitalization go up, simply because they're not so wedded to having to continually think about the dividend. You know, they're able to think about the business a little bit more holistically.
What are you expecting from 3M with the new CEO over the next few months? Like, when are we going to be at full velocity here?
That's a really good question. I know for a fact that the incoming CEO certainly likes to get up early. He likes to work weekends, and he's very keen on both lean management principles, and he's a big fan of M&A. 3M don't traditionally go outside of the company to look for executive candidates, so I'd expect you'd be shaking things up.
Well, really looking forward to that. I love 3M. I think it's so interesting because it makes literally everything. Kyle, thanks a lot. Really appreciate it. Kyle Porter joining us there from Bloomberg. I mean, not only the sticky Post-its, but like it makes like the film on solar panels. Like it makes all the things. Yeah, they do. I mean, I don't know. I still think, I mean, that healthcare business, the one they sold off, Solventum, I can't remember the name of it. But I mean, I was looking, I mean, that was really a driver, a big part of their cash flow here. And I mean, that's obviously the direct reason why they're cutting that dividend. You just wonder whether they're going to use that money, whatever money they would have been paying out. Is that just basically the Solventum money, or is this money now that's going to be reinvested into the remaining 3M? Well, from what Kyle's saying with the R&D, you can make an argument it could be reinvested. Anyway, we will be following that. How much R&D do you have to put into Post-its notes anymore? No, it's the film. It's the sticky films on planes and all this stuff. Oh, okay. All right, coming up, Chris Ailman, CalSTRS CIO, will be joining us as we head to the last trading day of April. This is Bloomberg. This is the countdown to the close. Romaine Bostick alongside Alex Steele. Just about 10 minutes to go, Alex, until the end of the trading day and the end of the trade for the month of April here. And I guess we're ending on a fitting note here, red across the board here, down about 1%. Yeah, if you were long stocks, long bonds, you're really happy to see this month go by. Yeah. Just taking a look here, two things I wanted to point out was the energy index is the real underperformer today. That's because oil prices are starting to roll over, some other commodities as well, like copper off its 2-month high. And also GE Healthcare is the worst performing stock within the S&P. Basically, medical devices really struggling versus Tenet, which, as you pointed out, that's hospitals doing well. Yeah, it's a real interesting dichotomy in the healthcare space, because, you know, everybody was rushing in there. Everyone said healthcare was a big trade, and that included the medical device stocks, and they rallied hard at the start of the year. But as you saw those results out of GE Healthcare, I guess it shows that
I guess maybe we've already caught up with all our hip replacements and all the other things.
Well, now it's an insurance story.
Defibrillators or whatever.
Yeah, exactly. Now it's an insurance story, right? It's you're doing all the stuff, and now the insurance companies have to reimburse, and they're getting hit on that. So it's just sort of the rolling ball, maybe.
Yeah, absolutely. Here, two big stories going on in the market right now. Another big one, of course, is the start of that 2-day Fed meeting down in Washington. A decision tomorrow. Not expecting any change in policy tomorrow, but maybe a change in what they're willing to telegraph. We had a chance to catch up with Vanessa McMichael over at Wells Fargo, and she talked about the recent economic data and how it has changed Fed cut expectations.
Now we're in this place where the market is expecting only one cut. And so our clients are still thinking that we're going to cut at some point this year. At Wells Fargo here, our economists are expecting 2 cuts, the first in September, the final one in December. But obviously with the recent economic data that continues to come in, there's some risk that perhaps 2 could turn into possibly only 1.
All right, Vanessa McMichael there over at Wells Fargo helped us kick you off to the close just about an hour ago. And here to help take us to those closing bells is Christopher Ailman. He's a CIO over at CalSTRS, overseeing more than $300 billion in assets under the portfolio. And Chris, let's start off with those rate cut expectations, because as you know, a lot has changed over the past 3 or 4 months when everybody thought we were getting 4 or 5, maybe 6 cuts this year. The market right now only pricing in 1, though the Fed still has 3 on its dot plot.
Well, in Romaine, you've got to look. You hit it on the head. Back in December, they were looking for 6, then 3, now 2 and 1. Market has to readjust. So this has been a huge change in the shift. It's actually taken it in stride. I'm not surprised April's been so tough. Look how strong January, February, and March were in the market. It almost got ahead of itself. So, the Fed's going to be data dependent. I think we've adjusted to 5% interest rates up here. And the economy's doing okay. So I bet they're going to continue to hold for a while. That's news to the market. It's got to adjust to that.
Well, what is the psychology in the market? I mean, there's been a lot of discussion here about that some of the sell-off that we saw in April was really a lot of folks just kind of protecting their profits from the first quarter. And then, of course, there's the seasonal factors. If you believe in the whole, sell in May and go away idea, that we could see maybe the price action get even worse over the next couple of months.
Well, I think you hit it on the head. Old adages still hold true, Romaine, and sell in May, go away, because the market is kind of choppy. It's gotten ahead of itself. We have to see earnings. I mean, like you said, we're waiting for Amazon in a few minutes. And the earnings have been okay, but not spectacular. AI is expensive as they build it up, and so far none of us are paying a lot for it. So the revenues will come, but it's the market reassessing its expectations. I think we're in a good place, but I think the market's going to go sideways. You can easily have a 10 to 13% sell-off in a bull market year. So people have to be ready. This market could be choppy during the summer. We've got the election. The Fed's going to be data dependent.
Chris, I asked this question on radio. Cameron Christ writes great stuff for MLive. He writes a column every day, and his first line today was, one of the basic principles of successfully navigating financial markets is that you should only date, not marry your positions. And the question I was asking is, what position should you date right now, and which one should you marry?
Alex, I actually heard you this morning driving in, listening to the radio, and that was a very interesting discussion, because I'm going to make a shout out to my wife, Robin, 40 years this month of May. So commitment. I think you stay married. And I think I'm a long-term investor, Alex, so I'm going to buy the beta of the market and hold it. And I'm okay being married to positions. I don't necessarily believe in trading and trying to time the market. And I've learned that the hard way myself. And for our fund here, we've done very well by being invested through thick and thin. Maybe you flow a little bit, but you diversify the portfolio 70-30, you hold for the long term, and you stay married to your asset allocation. Don't worry about individual stocks.
70-30. Okay, what happened to 60-40, or what happened to like 60-30-10?
Hey, 60-40 went out as interest rates went down below 7%, down to 5, down to 2, down to 0. Now we're back up to 5. So I think you can be a 70-30, and I think more people need to look at that. The baby boom has to start diversifying their portfolio. Finally, they're all in their 60s, and yet they love equities. So I think you've got to really see that fixed income has a return. But 60-40 is in the past. It's 70-30. 80-20 is what the typical pension plan is, and then a typical endowment is 90-10.
I am curious. Well, let's fold in also private capital into that, Chris. I mean, CalSTRS, of course, was at least one of the bigger pension funds out there to kind of gravitate into the private equity space as an allocation, as a proper allocation here. And we've seen those allocations go up pretty significantly, not just at CalSTRS, but at some of your peers as well. What is the role of that right now, particularly given the lockups and particularly given some of the concerns that the last vintages that we saw, at least for right now, haven't delivered?
Yeah, Romaine, that market is absolutely frozen. I still think there's a place for private investments in a diversified mega, and I'll call us a mega fund at 300 billion portfolio. When I got here 25 years ago, we were in the single digits in private equity and real estate. Now we're at about 15%. So let's call it 35, 40% in private markets. And I think that's the right place for us. But you're right, they've been very slow. Real estate's got to adjust to whatever is going on in the office market and to this new level of interest rates. And I think it is. You're starting to see some transactions. But boy, private equity is just frozen in here. We're not having a merger Monday. I need you guys to be hitting the airwaves on Monday with merger acquisitions, companies selling their divisions. Then that market will unthaw. It's not so much interest rates. I think it really is a hangover of the economic shutdown from the pandemic. We just haven't seen a lot of transactions, but they'll come back. And those markets, I think, still offer a premium over public markets for long-term institutional investors.
All right, Chris, always great to talk to you. I have to leave it there. Christopher Ailman, the CIO over at CalSTRS, helping us count down to the closing bells. Just about 2.5 minutes until we get there as we close out not only the trading day, but also the month of April, Alex, and sitting on some pretty steep losses for the month. The S&P down 4% in April.
Yep. At one point, though, the 10-year yield was up 53 basis points in just 4 weeks.
A lot of volatility, too, we should point out, over the last 4 or 5 weeks here that's going to have a huge impact on psychology as we break down all the market action for the day and the month as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast. We're joined right now by Carol Master and Tim Stenovic in our radio booth. Scarlet Fu on assignment right now, but we welcome all of our audiences across all of our platforms here on the final trading day of the month, Carol, and it is not a pretty one.
No, we saw some selling, right, in the last few minutes of trading. What it was good, though, is to be a cannabis stock. I'm going to talk about it a little bit later in my gainers, but nonetheless, it looks like the DEA is going to reclassify those drugs. So talk about stocks flying high today versus what we saw in the overall market.
Yeah, as you mentioned, we're seeing a little bit of selling just across the different indices. But Amazon down 2.6% going into earnings, which are expected in the next couple of minutes, Alex. And of course, we're going to bring you those numbers as soon as we get them.
Yep. And the age-old question, is this the start of a deeper correction, or is this just a normal kind of sell-off and there'll be a buy the dip tomorrow morning if Amazon numbers wind up coming in strong? It's been the question that's been plaguing us for the last couple weeks.
Yeah, and I think, though, I mean, too, talking with a lot of people, they really start to talk about how those pairwise correlations that you see within these indexes have really kind of broken down. So even if you do get a big number out of Amazon, is that going to be a rising tide lifts all boats, or just a rising tide that just lifts Amazon?
You look at the S&P 500, almost 450 names to the downside, 445 to be exact, 56 actually gaining ground. So you're seeing it's pretty broad-based selling that we are seeing, and kind of the turnoff, and a lot of it had to do with the earlier economic news this morning, Romaine.
Yeah, and that economic news, it really wasn't good. You talk about home prices continuing to go up, consumer confidence going down, and then, of course, that employment cost index that everybody is obsessing about here. It shows you that, you know, if you think the Fed is heading into that meeting today and talking about rate cuts, you got another thing coming. All right, let's walk you through the numbers here before those earnings hit red across the screen here on this last trading day of the month. The Dow Jones Industrial Average lower on the day by about 1.5%, and that's going to lead to a 5% decline for the month of April. The S&P 500 lower by 80 points, or also by about 1.6%, down 4.2% on the month. The NASDAQ Composite down 2% on the day, about 4.4% on the month. And let's go to the Russell 2000. That is your primary laggard here, down 2% on the day. And for the month of April, a 7% decline. And just to put a finer point on this, Russell 2000 wiping out all of its gains for the year. All
right, guys, earnings are already crossing, and this has to do with Caesars Entertainment. First quarter net revenue coming in at $2.74 billion. The company also reporting a first quarter loss per share of 73 cents. So we're seeing this one, same store net revenue to an important metric for the first quarter, missing the average analyst estimate. We're seeing shares of Caesar just unchanged a little bit. The stock's down about 21% so far this year, but investors kind of maybe waiting for a little bit more context around those earnings.
All right, Amazon earnings now crossing the wire here. Net sales in the most recent quarter coming in at about $143.3 billion. That's a slight beat. The street was looking for 142.6, so not a major beat here, but indeed they did come in above expectations. First quarter EPS 98 cents. The street was looking for 83 cents, so a beat there. Let's get you to the forecast right now. The company is saying that for the second quarter, it projects net sales to be 144 billion to 149 billion. The street was looking for 150, so a miss on that should that guidance come true. Operating income for the second quarter guiding to 10 to 14 billion dollars. The street looking for 12.6 billion, guys.
I just want to point out AWS, so Amazon Web Services net sales, if you back out FX, coming up 17%. The estimate was for 14.5%. The rumors on the street was anything 15, slightly plus, was already priced in, but 17 does feel like a more solid beat there for AWS.
Getting some commentary from Andy Jassy about AWS, President and CEO of Amazon, of course, a history at AWS. He says the combination of companies renewing their infrastructure modernization efforts and the appeal of AWS's AI capabilities is reaccelerating AWS's growth rate, now at a $100 billion annual revenue run rate. Also talking about the stores business continuing to expand selection.
Yeah, looking at first quarter operating margin, I mean, they did well, 10.7%. The estimate on the street was 7.63%, right? So key in terms of their ability to operate efficiently, if you will, and profitably. But it's interesting. And now you've got shares of Amazon, which have been kind of initially trending lower, now up about 4.9, almost 5% here, more than 5% here in the aftermarket, guys.
Yeah, there's a lot of talk in here. Of course, they go through all of their units, but a lot of talk, a lot of attention devoted to Prime, and particularly with the streaming business here. Some of the content that they're saying that they're going to add to that, and of course, some of the money, the ad revenue they expect to get off that as well. Kind of interesting, too, that when you look at some of the other businesses and the commentary about the retail side of it here, they do talk about trying to diversify the product lines out there, particularly with some of these Amazon brands, which of course don't actually say Amazon on them, but they're effectively the brands that they themselves are shepherding to that marketplace.
Yeah, and you know what they talked about a lot on the press release? AI. It talked about how generative AI is being used by all its customers in many different kind of ways. And to your point, Tim, as you were saying, that it was the combination of an infrastructure modernization effort and AI capabilities that have really helped AWS and provide that growth rate of $100 billion annual revenue run rate for AWS.
Is that why investors are excited in the after hours? They changed their mind after these numbers came out. Maybe net sales coming in a bit light, but then if you look more closely, you see AWS net sales excluding Forex up 17% when estimates were for only 14.5%. Maybe that's what has investors excited.
You know, it's also interesting. I did a quick search for buyback or dividend, and that's not coming up in the press release. And I think there was some speculation.
Tesla and Amazon now without those, right?
Yeah, I think there was some hope, some speculation of whether or not that they would join the crowd that we've seen among the other Magnificent Seven, but not the case, guys.
Yeah, well, they certainly have the cash to do it if they do actually decide to go there here. And again, you get to this idea of why the shares are rallying, and maybe it is that cash generation. You're talking about operating cash flow in the most recent quarter.
Yeah.
You saw this?
Yes.
You're basically talking $100 billion that they're pumping out here.
82%.
And that's an 82% jump on a year-over-year basis. Now, we should point out, seasonally, you do kind of see some of these numbers go up, particularly in that first quarter here, but that's still phenomenal. We should also point out, this is 1, 2, 3, 4. This is basically the fourth straight quarter that we've seen that cash flow growth in that range, 74%, 81, 82, 82%. Those are your numbers you're looking at.
I was also looking at any capital investment, CapEx, to see if that's growing, and that's what you're kind of going to do with all their cash. And I haven't gotten a real clear read on that. The one that they really talk about is a planned $10 billion investment into a data center in Mississippi.
All right, I'm looking at shares of Starbucks right now in the after hours because the company just out with earnings, shares down by 5.9%. Let's go to the numbers as we speak. Second quarter adjusted earnings per share coming in way below estimates at 68 cents. Estimates were for 80 cents per share. Second quarter comp sales down 4%. Estimates were for a gain of 1.46%. So we're seeing miss on both of those things. Shares now down, 7.4%.
Yeah, I'm just trying to look a little bit for international comp transactions. operations down
I know,
a bit.
it's really bad.
Yeah, okay. China comp sales down 11%. The estimate was for a decline of 1.6%. So that is certainly a big disappointment. And we know that there's been pushback not only in China, but also some of their other operations, certainly around the world.
I mean, overall, international, as you point out, Carol, was down by 6%. And it's partly because of its transactions and the average ticket, so people going less and they're also buying less. I'm trying to get a read on, say, Middle East, for example. We saw McDonald's get hit by that, and that's not broken out in their release right now.
All right, I want to make a quick pivot here. We are getting some other earnings. Of course, one of the AI darlings, Super Microcomputer, those shares, they have tripled so far this year. They're up about 7% in after-hours trading after the company said that adjusted EPS did come in above estimates. The company also saying, giving a forecast for the quarter, basically saying that it sees 4Q adjusted EPS at 762 to 842. The street was looking for 697. So even the low end of that range would be a pretty big beat. A similar story for the range that they're giving for numbers for sales, saying net sales in the most recent quarter, 5.1 billion to 5.5 billion. The street on average was looking for 4.7 billion. So a pretty big beat there. And maybe that answers some questions here about whether all those folks who are front running this sort of AI boom here, whether that was justified, and at least based on just those couple of numbers I read you, at least on the surface, it looks like they were right.
Well, speaking of beats, let's look at Pinterest, because shares of Pinterest are up by more than 20% right now. First quarter adjusted earnings per share beat estimates. First quarter revenue coming in above estimates at $740 million versus estimates of $700 million. First quarter adjusted EPS also came in above estimates by 6 cents. And then first quarter loss per share was 4 cents.
All right, folks, let's go back to certainly the big one here, the behemoth, if you will, in the aftermarket, and Amazon. Again, a lot of it has to do with the outlook. Second quarter net sales, 144 to 149 billion. The estimate was 150.21. But I'm looking at Amazon still up about 4.9% in the aftermarket. And so investors, at least initially, definitely liking what they got from the company. We'll see what kind of commentary and further color, if you will, around the business and AI and all that good stuff around Amazon as they start to take the call. All right, guys, a wrap. Earnings continues. Our cross-platform radio, TV, YouTube, Bloomberg Originals, Beyond the Bell. We will see you again, same time, same place tomorrow.
And we continue our coverage right here on Bloomberg Television. A lot of earnings crossing the wire. The biggest of them all, Amazon. Those shares up about 5% here in after-hours trading. The company beating on several key metrics, including 13% growth in net sales, a beat on EPS. And while some of the guidance comes in just a tad light here, investors still pleased here with the overall complexion of what they learned out of this earnings report. To get more insight on what we learned out of this earnings report, let's bring Ed Ludlow into the conversation, co-host of Bloomberg Technology. And Ed, what's driving this right now? Is this still an AWS story, or is there something more to it?
I think it's the factoid about AWS in Andy Janassy's commentary that AWS is on a $100 billion run rate annually. It was a $90 billion business in 2023, and learning from Alphabet and also Microsoft's earnings prints, you have to give the street something, a figure that shows there is a tangible growth in that unit that's directly linked to generative AI, and that number seems to be doing the work in this after-hours session.
Talk to us about kind of what the strategy is here, because, I mean, we sort of talk about Amazon as kind of a retail business or maybe even a logistics business, but when you look at the growth of AWS and, more importantly, what it's now contributing both in terms of to revenue and the bottom line, I mean, this is basically a cloud and AI company, or at least it seems to be morphing into that.
Exactly so. AWS is the clear market leader in cloud, bigger than Microsoft Azure, certainly bigger than Google's cloud platform. It's seeing accelerating growth. Growth in the fourth quarter was about 13%. It's now nearer to 14.5%, 15%. And the strategy is basically to be a place where other companies who are interested in AI can build whatever software it is they want on AWS's platforms. You know, the frustration from the street has been, why can't you show us this kind of shiny generative AI use case like Microsoft has done? Microsoft just took the OpenAI relationship and put AI into their existing software, and the street really liked that. With Amazon, they've resisted the urge to do that, a generative AI or chatbot tool, and basically said, we're a cloud company, come to us if you want to build AI. And now it's showing up in the financials.
Hey, we're in conversation right now with Ed Ludlow, the co-host of Bloomberg Technology. I'm Romaine Bostic here on The Close. Joining me right now to kind of help walk us through all the earnings that we're getting fast and furious is Sonali Basak. And Sonali, you saw the numbers here, and Ed's just talking about it here. This is still a growth story. It's just not one around retail, more around data centers and cloud and AI.
Yeah, and it's interesting to see the stock reaction here, Romaine, even with that estimated guidance here falling below where they're actually guiding. You know, Ed, how do you think about this moving forward? What are investors reacting to? The idea of a future promise of a potential dividend, given they didn't hand it over today, is the idea here that they're making just so much cash that one day they could hand it back, maybe, or that they would rather, investors would rather Amazon be putting their money to work.
I'm smiling because buybacks and dividends are in vogue, you know, for the technology sector. And a big part of that has been, at least you could argue, that they don't really know what to do with their cash. You know, making a big acquisition is pretty tricky, particularly in North America right now. You know, Amazon is going to have to show us something they've not put in the earnings statement, and that is capital expenditures. It's all well and good to say cloud's growing and it's growing thanks to AI, but we know from Meta's example, the data center spend is going to be really heavy. The story for AWS has changed quite dramatically. Like end of 22, beginning of 23, cloud customers were pulling back. They wanted cheaper alternatives from their cloud providers. Now it's all in on AI, but you have to see the companies invest in the infrastructure. You know, look at the earnings release, Control F on your Bloomberg and look for the words capital expenditure. They're not there beyond that one single reference to the $10 billion specific project that they outlined. So that's going to be something to listen out for on the calls.
Until this point, you did not see the same stock price reaction in Amazon throughout the year as you did in Meta, which of course did react really negatively to that extra spend. But for Amazon, given that they didn't see the same run up this year, if they do have a large number in CapEx, would they still be able to have a bit of a lift here in their stock price, given they didn't see the same kind of rise earlier this year?
Yeah, different investors want to see different priorities. You know, since Andy Jassy has come in as CEO in the last couple of years in particular, it has been a story about belt tightening and focusing on margins. There was this kind of all-in emphasis on speed, particularly on the retail business or Amazon.com, right, in the early days of the pandemic. And Andy Jassy in the first instance had to unwind a lot of that, focus on profitability. Similar story with cloud, where Andy Jassy's origin story comes from. That's where he was before he was CEO. It's very similar. You know, some investors want to say, show us the money, like really invest in this, capture the market. And others want discipline. And getting it right, as we learned in Meta's case, is really tricky. You're damned if you do and you're damned if you don't.
All right, Ed Ludlow, co-host of Bloomberg Technology, a closer look at Amazon earnings. We continue that coverage right now, and we continue this conversation with Eric Clark, portfolio manager over at Accuvest Global Advisors. And Eric, I mean, on the surface, this looks good. Are you pleased, not just with this one report, but kind of really the trajectory that we've seen since Jassy took over a couple of years ago?
We absolutely, hi, by the way. Yeah, absolutely. We are completely pleased with progress. There's so much opportunity, but opportunity requires capital, and you can't have one without the other one. So if people are concerned about CapEx spend, then you can't get the growth that's associated with that CapEx spend. And it's much higher ROI spend than was the logistics spend that they did, through the pandemic. So we're super happy about the AWS, as well as the stability in retail with increasing margins, good free cash flow. And I didn't want this potential dividend. I'd much rather see a buyback if they're going to do anything on that side at all. But Amazon's great at spending money for good ROI over time. And that's what they seem to be doing as well currently.
And that brings up a good point, too. When we talk about, the capital discipline, for lack of a better phrase here, there's still the question that with all of the capital that might be needed in this AI push, that there might have to be maybe a little bit loosening of that discipline, or do you think they can continue down that road and still make the investments and still stay on top?
Well, I think they can, because they have finally gotten their cost structure under control, and that's a big company. So when you have cost efficiencies and you have margin expansion and you generate a bunch of free cash, that allows you to spend on really important items. And that's not just Amazon, other companies too. When you have that free cash flow and that stability and that access to capital, you get a chance to spend where others can't, particularly at a time when the cost of capital is pretty high.
With the cost of capital being that high, do you look at the cash on hand differently for these big tech giants, given that the ones with the extra cash have that flexibility, don't need to go back to the markets at all for that extra dollar? When it comes to Amazon at the end of the day, is free cash flow perhaps the biggest thing on this statement?
It is. I mean, historically, the stock's been very correlated to free cash flow generation and operating income, expansion. And so, we had a few years where they were spending radically and the stock was down. I mean, remember, the stock has historically compounded really well since the IPO, but over the last 3 years, it's still only annualized about 1%, well under the normal for Amazon at a time when they've doubled revenues and increased margins. So there's major catch-up potential in this stock. It's just back to 2021 highs when a lot of the other brands have far surpassed that one. So that's one of the reasons why it's such a big holding, our number one holding, because we think it has the most upside potential of all the Mag 7 names.
All right, those shares up about 3% right now. In conversation with Eric Clark over at Accuvest. He's sticking with us, but we just want to make a quick pivot here. AMD, those earnings now crossing the wire here. It does look like a modest beat here on the most recent revenue number for the most recent quarter, I should say, $5.5 billion. The street was looking for $5.45. Adjusted EPS in the first quarter coming in at 62 cents a share. That's a beat by 1 penny. The guidance going forward, revenue for the second quarter, they're giving a range of $5.4 to $6 billion. The street was looking for 5.7, and their guidance for adjusted gross margin for the second quarter, they're saying it's going to come in at about 53%, and that's pretty much on the nose of what the street was looking for at 53%. Those shares, Shanali, right now down more than 3%.
We're going to bring back in Eric Clark here at Accuvest Global Investors and advisors. And you look at this AMD reaction here, and you have to wonder the divergence that's happening here among technology giants and the ability for them to squeeze out the juice of this AI boom. How big is that divergence?
Well, first there is spending on the infrastructure, and then the companies that are spending get a chance to monetize. So this is a much longer theme. I know the markets love to pull forward all the excitement, and it's been mostly for NVIDIA. But in the end, it's the companies that adopt AI and allow their margins to expand because they have a lot of efficiencies that'll really benefit from AI spend. And that just takes time, right? We're in inning one of the build out part, and then companies get a chance to monetize that. And that's really where you're going to see operating metrics get a lot better. And if that happens, PE multiples can expand too. That's really where we're headed. We're just in inning one.
Final question, and this may be a dumb question, Eric, but when you look at this company now and how vast it's gotten, it's a retail company, a logistics company, it's data centers, it's AI, now it's streaming television here. Is that at all a potential risk? The idea that it's almost kind of built itself into, I guess, somewhat of a mini conglomerate here. Do you worry at all about that?
Well, you worry about it because in some ways it kind of it trades sometimes with this conglomerate discount. But the funny thing is, whether you do a sum of the parts analysis or you just say, what if AWS was either spun off or forced to be spun off, that actually would unlock a massive amount of value, and the stock would go, I think, meaningfully higher. So, sometimes you worry about that kind of thing, but I have no doubt that Amazon will be the first company with $1 trillion or more in annual revenue at some point. I mean, they're already at $575 billion, and so it's not a far cry if you just do math. A decent high single-digit, growth in revenue over time with free cash flow. This company's going to generate a lot of top line, a lot of free cash. And whether it's a conglomerate or it ends up being, kind of tracking stocks for different things, I still think that, the thing's 275 to 300 over time. And you're at, whatever you are now, 180 something now. So still pretty good upside.
Eric, we thank you so much for your instant analysis there of Amazon's results. That is Eric Clark of Accuvest Global Advisors. Now, coming up, we're going to talk about the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. That's up next. Stick with us. This is The Close on Bloomberg.
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Welcome back to The Close. I'm Romaine Bostick.
And I'm Sonali Basak. We're going to take a look at where the markets closed out today. It's a tough tape out there, wasn't it?
Absolutely.
We look at the S&P 500 down about 1.5% on the day, more than that. And the NASDAQ heavy index here, NASDAQ 100, tech heavy, down 1.9%. Of course, that was before Amazon had reported results today. We'll see where the market heads tomorrow, Romaine. Also, an interesting sell-off here in the bond market. You have the 2-year yield flying past the 5% level, now closer to 504. Sitting at around 503, and the 10-year yield also at 467 before a big Fed day.
Absolutely here. This was one of those 90% down days for the S&P 500. You see a couple of the stocks. Take a look at two of the big car companies. Tesla coming off that 15% gain yesterday, giving back about 6% today. But Stellantis, big story there, down 11%. That was the worst drop we saw in that company going back to the onset of the pandemic in March 2020. Of course, this is the maker of Chrysler and Dodge and Jeep. They basically said they were dealing with a lot of margin pressure right now in Europe, and they don't expect that to improve. And then Globe Life cannot get a break. This was the worst performer in the S&P 500 in the month of April. It was only down 2% today, but that adds to what is now basically a 50% drop that we've seen over the last few weeks here. The latest shoe to drop was a short seller report really attacking the company. All eyes right now on Globe Life. It has become one of the most traded stocks out there. We should talk about, though, a big story, at least my top story of the day, and it's one of the big reasons why you see any green on your screen on the day. Here in the U.S., the Drug Enforcement Agency is said to be moving to reclassify marijuana as a less dangerous drug. That's according to Bloomberg reporting, and you see marijuana stocks really rallied on the news. Tilray up 40%, the best day for that company in a couple of years. Two of the big ETFs tracking this, including the MJ Index as well as the Advisor Shares MSOS, also getting a pretty strong bid. In a nutshell, Sonali, what all this means is that effectively, if this turns out to be true, marijuana would go from being Schedule 1 drug, which is basically the strictest schedule that you have, and that's kind of where heroin and cocaine fall into. It would be reclassified as Schedule 3, which is kind of like where things like ketamine fall into. So basically, it would allow folks out there to obtain marijuana through a prescription. Now, this does not affect recreational use, which would primarily be for medical marijuana. Nevertheless, though, a huge milestone in the U.S. if the DEA does follow through on this.
And Romaine, outside of the top stories, it's also time now for the top 3. Every day at this hour, we do a deep dive into the people at the center of today's top stories. And up first, we're watching CZ, the Binance CEO, sentenced to 4 months in prison for failures that allowed cyber criminals and terrorist groups to freely trade on the world's largest crypto exchange. What's interesting is that we reported here at Bloomberg that his fortune is even set to grow from prison.
Yeah, it was crazy. I was looking at the numbers. Binance's actual holdings have actually gone up since then. Everyone thought they would get killed, and he's doing 4 months in prison. He still got his money, and I don't know. Have we learned anything from this?
I think we've learned a lot, including that crypto is actually down the worst it's been since the FTX crash, and you haven't seen a crash like that yet.
All right, someone else I've been keeping an eye on is Noel Quinn, the CEO of HSBC. Well, no longer the CEO, unexpectedly stepping down after 5 years on the job and almost 4 decades at the company. This surprised a lot of folks, but given some of the troubles the HSBC has been dealing with, as well as just the whole changing landscape of what we're seeing over in Europe and in Asia in terms of banking, I guess maybe not surprising that maybe he said, look, I'm old. I'd rather do something else and let some younger guy deal with all this nonsense.
He's not too old. He's before the traditional
I shouldn't call him old, but he's had a long career. He's made his money. Go have some fun.
It's not that fun to run a bank. We can all agree with that. No. The other person I'm watching, much more fun to run a technology company, that is Sundar Pichai. The Alphabet CEO is on the cusp of becoming a billionaire. Stock in the company has surged around 400% since he stepped into that role in 2015. I'm very interested that Sundar Pichai became a billionaire after after Jamie Dimon.
Yeah, it's interesting too. But it's also interesting too the number of founders who've achieved this level of wealth. I mean, there's a pretty small club. I mean, obviously Tim Cook falls into that as well here. But you talk about a guy who not only was not the founder, but he was like the fourth CEO. So I mean, it's not like he came in right after Bill Gates left or something. I mean, not Bill Gates. Excuse me. After who was it? Larry Page.
Man, ever the perspective. I'm losing count myself.
I'm losing. So I'm losing my mind. I'm getting old, Shonali. All right, when we come back, we're going to get some insight on those results out of Amazon. Brent Thill joining us over at Jefferies. This is The Close on Bloomberg. All right, a number of companies out with earnings in the last couple of minutes. That includes Amazon, but it also includes a few others. AMD out, Starbucks out, as is Pinterest. Joining us right now to walk us through what we learned is Isabel Lee, Jess Menton, and Denitsa Sokova. Let's start with Isabel and the biggest decliner right now in after-hours trading.
Hi, Romaine. Biggest decliner indeed. Starbucks shares post-market are down around 10%, and the company posted its first ever sales decline in more than 3 years as customers really pulled back on spending. This despite a lot of half-off deals and a lot of new drinks, including lavender oat milk latte. So the weakness we saw, it's a 4% decline in same-store sales, which is a core metric for growth. And this is despite the 1.5 gain analysts were expecting. So you can see the divergence there. And the performance reflects many things. We have a war going on in the Middle East. We have a cold January, and we just really have a sluggish consumer base. And the pullback was also widespread. We saw overall spending fall around 6%. EPS was also lower than expectations, and consolidated net revenue fell around 2% to $8.6 billion. But this doesn't come as a shock because Starbucks last quarter also reported lackluster sales, so many analysts weren't really expecting a dramatic turnaround this time. The CFO did acknowledge that they had a weak quarter, but also said that they have a path forward to growth. And shares are still lower by 10%. Year to date, it's down also 8%. What do you got, Jess?
Well, Isabel, we're taking a look at the latest that we can see, especially when it comes to the AI fervor that we've seen over the last year. So looking at AMD, Advanced Micro Devices, which just posted results after the closing bell, you're looking at the stock down about 4%, but did come off some of the lows that we did see. That stock had been down more than 5%, so it did beat on EPS and sales. But when looking at the current quarter revenue outlook, it's actually around the midpoint range where those estimates were supposed to be around $5.7 billion for the second quarter. Obviously, the two key metrics here, especially on the earnings call, listening in about their outlook when it comes to those AI chip sales, the MI300, which is supposed to be the chip that rivals, obviously, NVIDIA's, and then obviously the PC market, especially on the back of what happened with Intel, just reported actually its worst month of actually since 2002 there. And so especially when you're looking at the operating losses, especially when it comes to its chip manufacturing division for Intel coming off of that. But though it did see recovery in its PC sales, so you are seeing that optimism when it comes to a stock like AMD, though that stock is actually up 7% year to date. So it is outpacing the broader NASDAQ 100, but we still won't get NVIDIA's earnings until May 22nd, Denitsa.
Yeah, Pinterest is having an amazing day. It jumped more than 20%. This is because it beat estimates, both the company-owned and the Wall Street estimates. Revenue came at $740 million, which is 23% jump and is well above the $700 million estimate. The two big boosts are Gen Z and more shoppable content. Gen Z now account for 40% of the users of Pinterest. That, of course, has been a big push for the platform, who has been trying to work more into those ads and sell more products. One thing that CEO has said many times is that they're using AI to help with that big push and engagement among other audiences as well. We saw a lot of activity in the stock earlier today in terms of options, both bullish and bearish, with the bullish prevailing. So you can imagine that a big part of that reaction is coming from option activity. Of course, global users have come to more than 500 million, which is a record for the company, is also another big boost. And Romaine, one interesting thing for the next quarter is that the revenue comes at 850 potential estimate, which is way above what Wall Street estimates. So maybe more potential upside for the stock from here. All right, biggest gainer in after hours trading. Our thanks there to Denitsa Sokova, as well as to Jess Menton and Isabel Lee. A walk through some of the secondary earnings that we've gotten. And I'm just going to add a fourth on there, Shonali. Taking a look right now at shares of Skyworks. Those shares down about 6% here.
Of course, this is a major supplier to Apple, and there's been a lot of speculation about just how bad those Apple numbers are going to be in terms of volume of handsets sold. Based on what we're hearing from Skyworks, they're saying that their volumes for the components that they sell were down significantly here in the quarter. In fact, their fiscal third quarter sales actually came in 12% below consensus, and the company really making it clear here that they don't really see a recovery around the corner anytime soon.
That's a really smart catch over there, particularly because of that optimism around Amazon that we're seeing today. Looking ahead to Apple already, right? There's been a lot of divergence in these big cap tech names and a lot of concern, if you will, still under the surface.
Yeah, and it's interesting too, because I mean, we get Apple, Thursday night, right? Thursday after the bell. So we'll get a better perspective there. And obviously Apple has other levers to pull. They make a lot from services revenue. So it's not just about devices sold, but of course, we all obsess over those volume numbers, particularly overseas in China. So if Skyworks is hurting, that probably means Apple has to be hurting as well. All right, we do want to go back to the story of the day, and that is Amazon. Those shares have been bumping around here in after hours trading. The company reporting some pretty decent numbers here and showing that they can continue to grow. Brent Thill joining us right now, Jefferies equity research analyst. Brent, I mean, what jumped out at you most in this report? I mean, was it, I guess, the margin growth? Was it the revenue? What?
It's a combination of the cloud business, AWS up 17 versus our estimate at 15. You have the advertising business up 24 versus the forecast is 23. And then you have operating income 37% ahead. The other thing that really jumped out is the international profitability. That was up massively. It was a $900 million gain versus expectation for a loss. So we're seeing international get their act together on expenses. You're seeing the most important business, which is their cloud business, which is their highest percentage of their market cap is allocated to AWS. That business is now climbing out of what was a pretty tough year where growth rates decelerated. Growth rates are now accelerating. Backlog's been great. We're seeing cloud projects kick off, and AWS is the king of the cloud jungle as the leader over Microsoft and Google as it relates to revenue. So you're seeing the flagship cloud business really build, and that is, again, their highest margin business next to their ad business. So overall, just, check the box. Cloud, good. Advertising, good. And operating income in a good spot. The retail business in line, but investors aren't paying for Twinkies and toilet paper being delivered to your house. They're paying for these high margin recurring businesses like AWS, and that was really the strength.
I see what you did there, by the way, Amazon being the king of the cloud jungle here. But another question we've been having is this idea of whether Amazon needs to deliver any money back to shareholders in the form of a dividend. The fact that you didn't see one today doesn't matter. Is the expectation that they still will in the future?
They could. I mean, look, a lot of the mega caps are delivering a dividend, as we saw with what happened with Google. But at the end of the day, they're still a growth company, and I think that they're investing back into innovation, and they're delivering that through shareholder returns. So the returns have been good. They could be better, but certainly never rule out that over time. But right now, again, I think the real focus is getting the cloud business back to full health. It's not quite there yet. Getting their AI business back up to speed. Their AI business, again, relative to Microsoft, they're playing catch up. So there's other areas that they need to put their cash right now rather than, in my opinion, back into a dividend. Certainly never rule it out over time. But I think, again, where they've spent capital, there's other areas that they want to focus on, which is how do you reinvigorate growth and get the bottom line tight before you're worrying about that.
Brent Thill of Jefferies, we thank you so much for your time. Of course, it's been a very busy 2 weeks for you. And of course, Apple earnings still after the bell on Thursday. But for today, let's take a look at how the markets closed on the day, because it was a tough tape. The S&P 500, you saw down about 1.6% on the day, a tough day, tougher than we really had in weeks, really. The NASDAQ 100 down 1.9%. Of course, that was before Amazon reported, Amazon flying after market. And the 2-year yield at 5.03 before a Fed day. Economic data just driving a bond market sell-off. Then the 10-year yield hanging out at 4.67 remain.
All right, we'll be back in a moment with more coverage. This is The Close on Bloomberg. right. Jay Powell and the Fed began that two-day meeting earlier today. It was a morning where we also got another economic data point that shows inflation pressures persist. U.S. labor costs, specifically the Employment Cost Index, which measures wages and benefits, jumped by 1.2%. That was the most in the year, and it was well above what any analyst or economist in a Bloomberg survey had predicted here. That's creating a challenging print for the Fed, and it shows wage pressures keeping inflation elevated and raising a lot of questions here, not only about the state of the U.S. economy, but the state of U.S. monetary policy and how that policy will affect other economies around the globe. Who better to talk to than the former governor of the Reserve Bank of India, the former chief economist over at the International Monetary Fund, and now professor at the University of Chicago Booth School of Business, Raghuram Rajan. Professor, great to have you here on the program. A lot of talk right now about that inflation fight. And you know, just 3 or 4 months ago, I think everyone out there assumed the Fed was going to cut this year and cut multiple times. It's looking increasingly unlikely we're going to get multiple cuts. And now there are a lot of people positing that maybe no cuts are warranted at all. When you look at the economic data and you look at financial conditions, is there a case to be made for the Fed to just kind of stand still?
Well, I think the big question tomorrow will be what Chair Powell says about it. Clearly, nothing is going to happen on interest rates tomorrow. But the question is, how does he see events going forward? From the beginning of the year, we've really had almost every piece of data saying the economy is stronger than was thought at that point, and inflation is a little higher than it was expected. The readings are all coming out stronger. And so the question is, does Chair Powell think that we still have policies set at a restrictive level? It's just a matter of time before the economy slows to what is acceptable for the Fed and for inflation. Or is there a possibility that the Fed sort of thinks its setting might be even a little too accommodative at this point, given what's happening? I don't think you'll hear those words from Chair Powell, but certainly it'd be a question posed to him. Do you think you might actually raise rates even down the line?
I am curious. I mean, you obviously know what goes on behind closed doors in these sort of monetary policy meetings, given your experience in India here. Do you get a sense, based on what we know publicly about what the Fed has done from the minutes and their public comments, that they are indeed following the data, and not trying to front run it?
I think they are. I just think that the language got a little ahead of what we knew towards the end of last year, and certainly from the dot plots also, that there was, I think, significantly more optimism that the trend was going to be the Fed's friend, that it was trending down on inflation, and that would continue. And, the fact that we are in a very uncertain world, that we've switched from soft landing to hard landing to no landing and back, I think that would suggest a little bit of caution when the Fed tries to predict the future. And it should, with hindsight, have basically stayed with we will know when enough is enough and we can start cutting. But right now, we're not going to make strong predictions. That said, that dot plots do have to make predictions. And the prediction was that they would be able to cut far more than seems currently possible.
How much control, Professor, does the Fed actually have at this point over inflation? If you think about it, you mentioned the dovish pivot. There was also a lot of concern by a lot of investors and consumers, for that matter, about volatility around energy prices. And then you have the storm of fiscal spending above that. Do all of these things keep inflation high regardless?
I think it's hard not to conclude that the enormous fiscal spending is one reason why the Fed and the U.S. is in a very different place from, say, Canada, where you're seeing activity, slow down, and where the central bank is in a much better position to cut at this point. I think, the activity, the fiscal activity is part of the answer. But also, there's a lot else going on in the United States, which is different from other countries. For example, the fact that, homeowners haven't had to cut back because they're sitting on 30-year mortgages. And so interest rates aren't affecting them as much as they affect them, for example, in countries where mortgages are much lower duration. So the US is special. It's much stronger than the euro area, for example, at this point, which actually is impinging on the ability of some of those countries to cut. They're basically saying, if we cut, then we import inflation from the United States because our currency will depreciate. And it is possible that, what was a slowing economy starts accelerating once again, and we get more inflation than we bargained for.
And we're already seeing whiffs of that in the market already. Also curious here, Professor, about the short end and the long end of the curve. There are a lot of questions from investors on how much control the Fed has on both ends, particularly given the direction of quantitative tightening.
Yeah, I mean, quantitative tightening is probably the one place we'll hear some news in the, in the current Fed meeting. They'll tell us something about what they plan to do going forward. I mean, clearly, it has had effect on the long end in the past. But I think at this point, the big issue was really with the Fed withdrawing and with large fiscal deficits, who's going to buy U.S. bonds? In the short run, some of that has been answered. Yes, there is buying capacity in the market. I think in the longer run, as the fiscal deficits continue, whether this is something that we can be complacent about, whether interest rates start moving up because we're looking for buyers in the market.
How connected is the world right now? And I mean that in terms of when we talk about the moves and whether it's monetary policy, the differentials in interest rates, and of course, how that feeds into the FX space. Is that correlation still pretty strong?
It is, and the Fed is really the leader of the world in terms of setting rates. So everybody takes their cue. While the ECB bravely said we are independent of the Fed, we will do what we need to do. I mean, it does impinge on what happens in the euro area. The currency, how the euro moves against the dollar is a factor. And today, for example, we see in Japan, the Japanese yen has depreciated so much against the US dollar. And of course, there are concerns in Japan at this point that further depreciation might actually be problematic. So across the world, I think policies are connected, not joined at the hip, but certainly they affect each other. And you are seeing some effects from that in how other countries are thinking about their monetary policy setting. Maybe not cut as much as they anticipated earlier. And some countries have even raised interest rates in anticipation of what the Fed is going to do.
What does this mean for the emotional reaction from the United States? Is this translating to almost an anger around the world of not being able to really react to what the U.S. is doing and worrying about this currency fluctuation that's happening everywhere from Europe to Japan? Does the U.S. have to react to that?
Not really, because, I mean, the U.S. can say, look, part of the reason we are actually in a position where we can't cut is because our economy is strong and we're drawing your products in. We're buying a lot of stuff from the rest of the world. Our current account deficit is healthy. And so in that sense, we're helping you. So don't get too anxious about our policy. We have to manage inflation in our own country, and that'll be good for the world if we can do it.
All right. Always great to talk to you, Professor. Really appreciate you taking time for us. Raghuram Rajan, professor over at the University of Chicago, Booth School of Business. A nice preview here of maybe what we expect tomorrow when we do get that Fed decision and press conference. We're going to set you up for all the major events to keep an eye on tomorrow. This is Bloomberg. All right, with the eye on the Fed and the economy, there's a big eye on consumer spending, and tomorrow morning, we may get a better read on that. MasterCard set to report earnings before the bell. Bloomberg FinTech reporter Paige Smith joining us right now for more. I was just taking a look at the numbers. Pretty decent expectations here, 10% revenue growth, pretty decent EPS growth. What's the main thing you're going to be keeping an eye on?
I think that an interesting thing is that there has just been a lot going on in this space this quarter to watch, and from MasterCard as well. There was a huge settlement this quarter, pending court approval, mind you, with a Visa. It was a Visa and MasterCard settlement with a number of merchants, for example. We'll have to see if they comment on that in the earnings. But yeah, we'll be watching other. We'll look at EPS growth, for example, will be one we'll definitely watch.
How do you think investors will react to credit card statistics here? On one hand, they've looked at other card companies and said tremendous growth will take some of the write-offs here, but those write-offs are growing across these card issuers.
There's definitely delinquencies are on the rise among a number of players in the space, but Visa recently reported they fared quite well, as did American Express. Those are two very large players in the space, so we'll see.
Is there any sense here, though, that there's a difference in the consumer, meaning that you have wealthier consumers, like when you got the American Express results, everyone said, okay, well, that's wealthier people. Then you have lower end. I know MasterCard kind of straddles every world there, but are they affected by that dichotomy at all?
I think you kind of hit on it there, is that MasterCard does straddle all of those worlds. And there are a lot of, you have subprime consumers, you have sort of wealthier consumers as well. But I think that is sort of more sort of credit card company specific, whereas all sorts of folks turn to MasterCard rails.
All right, Paige Smith there. She's got a busy morning ahead of her here. A closer look at those earnings out of MasterCard, which are coming before the bell tomorrow. Team Surveillance will have full coverage of that tomorrow morning when they cross. Meanwhile, our coverage continues throughout the day of all of the big potential market moving events, and that includes some U.S. economic data in the morning.
Tons of it. You have ADP data, JOLTS data. Traders are watching very closely with the health of the job market and focus on Friday. And of course, Treasury refunding. Of course, all of these impact the bond market, Romaine.
And of course, a lot of those questions that we get, maybe we'll get some answers out of that, but a lot of questions are going to be posed to Jay Powell tomorrow, Wednesday, 2 p.m. The Fed makes its rate decision, and at 2:30, Jay Powell takes the podium for questions. We know not going to be any change in rates, but he's got a lot to answer for.
A lot of questions about that dot plot, and any concerns about a potential rate hike in the future. A lot of questions on the table. But of course, drink your coffee tomorrow, guys, because after the bell, tons of earnings still. And so it's a busy earnings season on top of a busy Fed day.
Yeah, we get quite a few earnings. Let's start before the bell. That includes MasterCard. We get Estee Lauder as well. So we'll get an interesting read here, I think, on the consumer. Kraft Heinz also in that group as well. And then after the bell, a whole different crop of companies scheduled to report.
Yeah, certainly after the bell, we have a lot going on. We have eBay, Qualcomm, DoorDash, MetLife, MGM, Carvana. We certainly have another big swath of the economy just in front of us, even though many have reported already.
Yeah, this is actually the best part of earnings season, when you get that more broad look at what's going on in the economy. Really hope that you tune in tomorrow here. We will have full coverage from first thing in the morning to the last thing at night right here on Bloomberg. I'll be back tomorrow here on The Close. All your politics news, though, that's coming up at the top of the hour with Balance of Power. This is Bloomberg.